Hey there everyone and welcome to this channel. Today we're going to study what is a bond. In finance terms, of course, not James Bond 007. That's not what we're talking about. So what really is a bond? Alright, so now, suppose I need to borrow some money. I can go either to my aunts, my father, my mother, my relatives, or I can go to the bank and get a loan. Similarly, a private limited company, or any company for that matter, can raise money either through equity or through debt. In order to raise money through debt, the company has to issue bonds. And that is exactly what we're going to study about today. Now suppose this company needs funds. It's an ABC company that needs funds, so it goes in the market and issues a bond for rupees 100. I'm an investor. I want to invest my money. I've got $100 lying around. I say, alright, sounds good. So I go ahead and give the company $100. The company issues me bonds. A bond. One bond, really. Okay, so the company got the funds that it needed, but what did I get? Yes, I got a bond, I got a certificate, but what does that really mean? Whenever you make an investment, you expect some return. So what kind of return do you get on a bond? Let's see. Bonds are usually quoted like this. 5-year, 10% annual, for rupees 100. That's how they're quoted. What does all of this mean? 5 years. So this is a 5-year bond. The company needs the money for 5 years. After 5 years, I will get my money back. So this is the maturity of the bond. 5 years. It could be a 1-year bond, could be a 30-year bond, depends on the company's requirements. Coupon. 10% annual. The company will pay me 10% annually. That means 10% on this 100 that I initially gave to the company, which comes out to be $10. So annually, every year for 5 years, the company is going to pay me $10. That is the coupon. And 10%, by the way, is the coupon rate. Whenever there's percentage involved, it becomes a coupon rate, while this $10 is the coupon. Simply. Alright. Face value, or the maturity value, or the redemption value, there are various names, or the par value that we can say. This is what I get towards the end. So really, just summarizing all of these, the sources of return on a bond that I get are my coupon payments. That is, the $10 that I get annually for 5 years. So 10 into 5, $10 for 5 years. That becomes $50. These are my coupon payments. Then this capital gains, really this is more of your principal. So I get 50, but I also get the 100 rupees that I originally gave to the company. I get that back at maturity. So in the 5th year, so the first year I'll get $10. Second year I'll get $10. Third year I'll get $10. Fourth year I'll get $10. 5th year I'm going to get $10 plus 100. So my original investment comes back. So my total return then becomes 150. But is that correct? No, my total return is more than 150 because we assume coupon reinvestment. What does that mean? The first year the company gives me $10. And I'm not going to just put that $10 in my wallet. It is assumed that I invest this further into some investment or in a bank where I earn a similar kind of interest, let's say 10% again. So now I'm earning interest upon interest. The company paid me 10, I invested this further and I'm getting $10. Or, sorry, whatever I'm getting on this. So it's interest on interest, right? Second year the company pays me $10. I again go to the bank and deposit this and start earning interest on this. And so on. So this is the third source of return on a bond that I get. So I get my coupon payments of 50, I get my principal value of 100 back, and I get my coupon reinvestment, whatever that may be. So that's it. So bond then is basically a loan. The company needed funds, it issues bonds. So it basically takes a loan of rupees 100 from me, from the bond buyer. I buy the bond for rupees 100. That means I've lent $100 to the company. The company in return pays me periodic interest, in this case $10 annually, and my principal, the amount I originally lent to the company, on maturity. That's it.